Hi, everyone. This is Jason Burack of Wall Street from Main Street. Welcome back for another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest, but he comes highly recommended from our mutual friend, Aaron Basil over at Carnivore Trades. He also does a macro podcast. He's a full-time options and future trader. His real name is Robert, but he runs a company called Infra, startup now, and they have a good global macro podcast. Robert, thank you for joining me.
Hey, good to be here.
So, Robert, we're recording this interview on Monday, April 7th, 2025. We can kind of call it Margin Call Monday if you want. The S&P
Yeah.
500 is around 5,000 still, but there was, an 8% intraday swing today. The VIX today, as of right now, when we're recording this interview, a little after 5 p.m. Eastern time, the VIX is still around 47, but you were telling me that in the early morning futures, it got as high as 60?
Yeah. Yeah. When it opened up, it was around 60. And yeah, that intraday move in S&P was pretty crazy. Like from the low right after open to the high, and then the retracement when that news turned out to be fake. I think in total that was like a 13% swing.
Have you ever seen anything like that? Are we talking like new types of volatility in terms of markets?
It sure seems that way. I mean, I'm on the younger side, but even the older people I've spoken to that have been in markets for 40, 50 years, even they have been saying, they've never seen anything like this. It's pretty crazy.
I think it's because of the leverage in the system. And you talked about this. You put out a short video. I think it was excellent. It's called The Silent Depression. And you were highlighting just how much money supply is sloshing around in there and how financialized our asset markets and the economy has become.
Yeah. So, and like a lot of work that I've done is like on that, the everyday person's experience. And like, you hear if you're a normal blue collar guy, you hear, the TV tells you, oh, GDP grew at 3% this quarter and real wages are up, and all these kind of headline numbers. But like what I try to do is go a little bit beyond the surface because, clearly, if you speak to most everyday Americans, especially on the younger side, especially the younger ones, they'll tell you that their experience couldn't be further from good. And so it got me really interested, like why that is, and have done quite a lot of like independent analysis on it. And one of the main things that you mentioned is the money supply is growing much faster than inflation. So you can take the US M2, which is the literal monetary inflation, the monetary base. You can take that and divide it by CPI to get an idea for how much CPI is underestimating inflation, and it's pretty incredible. If I started working in 2008, I was becoming an adult as Lehman was collapsing, and since then, if memory serves, it's about 60%, 60 to 90%, somewhere in that range. I don't have the chart in front of me, but a substantial
You're talking
amount.
money supply growth?
Money supply growth, more than the amount that money supply growth has outpaced official inflation.
Okay, so this is part of, I don't know if you're familiar with my work. I call this Stagflation tax life thesis. And the other thing I refer to almost every day is the Cantillon Effect, which is
Yep.
where, in my opinion, like the US federal government, so whether it's the Federal Reserve Bank, the Treasury, the Federal Reserve Bank was writing op-eds. You started around when I did back in 2008. That's when 2007 and 8 was when I became a financial professional as a stockbroker, unfortunately, back then during the 2008 crash. But they were writing op-eds, what about the wealth effect? But that's really the Cantillon effect. And I think the goal was to financialize the U.S. economy, what with these derivatives and trading. And the U.S. federal government wanted the home prices to go up. They wanted the S&P 500, the stock prices to go up. And that benefited the baby boomer generation. And then it benefited tax receipts at all levels of government, but it did not, as you pointed out, benefited the younger adults in our Generation X or Generation Y or Z.
Yeah, correct. And I believe that there was even, during I believe that the hyperfinancialization we've seen is a direct consequence of the dollar status. I don't think it's an accident. I don't think it's a side effect. I think it is directly linked to the dollar's reserve status, because basically the way the system was set up was, we will become the reserve currency issuer. And the way that we will get that reserve currency to the rest of the world that needs it is by running a trade deficit, an ever increasing trade deficit, I might add. And by running that trade deficit, we are exporting dollars. Dollars have become our major export here in America. We export those dollars. Well, any current account deficit just must be balanced by capital and financial account surplus. So what ends up happening is, we run this ever increasing current account deficit, we send these dollars overseas. Those dollars must come back. We must have a capital and financial account surplus. So foreigners start recycling dollars back into our capital markets. And so you see this kind of structural overvaluation of dollar denominated assets. And, some interesting stuff has come up. Like if you take the trade deficit and invert it, and then you take the median sales price of a single family home divided by the median family, the average family income in the US, those lines are almost identical. Really, the only divergence is during QE2 and QE3. Clearly, we know what QE did to asset prices. But the trade deficit is also directly correlated to corporate profits. It's also directly correlated to the net worth of the top 1% as a share of GDP. It's directly correlated to a lot of kind of, issues in our society that get blamed on other things, right? Like, oh, we don't tax the rich enough or this or that. But like, at least from my work, it seems to all kind of go back to the reserve currency status of the dollar and the trade deficit.
And the budget deficits together, so the twin deficits now, because they've gotten it compounded over the decades, where we had base case $1 trillion budget deficits for many years post 2008, zero interest rate policy. There's a lot of waste, fraud, corruption, and abuse, corporate bailouts, a ton of government spending and stimulus programs. That a lot of those funds were wasted. The national debt kept growing, and then you add on the trade deficit too. This gets us what was described back in the 1960s and 1970s. It was called Triffin's dilemma, and he didn't say it would happen right away. He was a famous economist back then, but he said that eventually the U.S. as creditor nation getting the world reserve currency, we would misuse it, and then he said we would eventually run into problems. And do you think that we're seeing Triffin's dilemma play out now on an accelerated timeline?
I do. I think we're kind of another phrase I think is pertinent is Dutch disease or resource curse. I think that both phenomenon describe the situation the U.S. finds itself in today. I think it's gotten acute, right? Like you look around at kind of societal things. You look at the suicide rate, and the suicide rate, I'm not talking nominal amount, but the rate per 100,000 has not been this high since the Great Depression. So there's clearly something going on there. You look at drug overdose deaths, and those are parabolic, over 100,000 a year. You look at the birth rate. The fertility rate is plummeting. You look at antidepressant prescriptions, up like 300% since 2000, 2001. So wealth inequality is at levels not seen since the Gilded Age. I mean, the wealth inequality was so bad, we named an entire era of American history after it. And the wealth inequality today is just as bad, if not worse. You get situations like the situation in Manhattan with the kid that, did a pretty horrible thing. But like these are the sort of second and third order effects that you start to see, in my opinion, in an end stage kind of Triffin dilemma.
Okay, so you're talking about the United Healthcare CEO, because there's a lot of terrible things now. I mean, I just see on the news headlines, there's tons and tons of terrible things now. But I think you brought up that the currency debasement. So I think that's an important part here is that people they don't realize it. They're blaming capitalism, which is unfair in my opinion. I mean, at this point, the people are saying eat the rich, tax all the billionaires. They could take 100% of all the billionaires' net worth, and the government couldn't be funded for more than about 6 months. So you could take all the funds from Bill Gates, Warren Buffett, George Soros, Elon Musk, all these guys, and the government still wouldn't fund itself. It would be under a year. That's how bad the government waste is. So the main problem here is not only the trade deficits, like you said, it's also DC spending.
Yeah, of course. And tax receipts as a share of GDP are actually in the upper band of historical norms. It's not a revenue problem. It's a spending problem for sure. I totally agree with that, and I also do agree that just personally, I kind of came into politics in 2003. During the Iraq War, I was kind of starting to pay attention to things, and it's ironic to me that the Democrats then were, saying opposed to globalism, right? They were opposed to NAFTA. They were opposed to the offshoring and
Well,
outsourcing of U.S. jobs,
they were anti-war for decades, right? So
and anti-war too. Yeah, yeah.
they were anti-big pharma. They were anti-war. I would say so. I've lived right outside Washington D.C. for almost around 25 years now, and I've seen like a lot of changes. I'm friends with lobbyists and a lot of government employees. I really think the party was changed structurally during the Bill Clinton era. So as him and Hillary were leaving the White House, they decided to align with the Davos crowd, the large corporations, big pharma, military-industrial complex. It was just more profitable to get in bed with the executives running those companies.
Yeah. Yeah, and the spending problem has been a lot of these problems have been a bipartisan affair. I try to remain objective, neutral, nonpartisan. Like you look at a chart of the debt, government spending, it's up no matter who's president. Until this kind of
The budget deficits were basically base case, Robert, like $1 trillion post 2008. That was like the base case. And then
yeah.
there would be bailouts, or there would be, you said you started paying attention to markets in 2019, the repo crisis. I mean, the
Yep.
Fed lied about how much the bailouts were then. I heard that large hedge funds had failed because they had borrowed. They had, because of the financialization in the economy, and the Fed was raising interest rates the last time during the Fed rate hiking cycle. These hedge funds and portfolio managers at investment banks had borrowed money from repo and then put on these leverage trades into the derivatives market and other stuff on like the over leveraged bond trades for risk parity, basis trade, all these things.
Yeah.
And they blew up and they secretly got bailed out.
Yeah, and like this is what kind of just makes sense. When you turn your uh, entire economy into one that is dependent not on making real productive
Manufacturing.
growth,
Yeah, actual,
right? Yeah, actual goods, actual tangible goods. And this gets into something else that I think is really important. Like if you take GDP and you divide it by the gross federal debt, or you take GDP and you divide it by the M2 money supply, we stopped getting real growth. Like we have been getting diminishing returns, and this goes to the hyperfinancialization of the economy, which is you make the dollar your primary export, and that dollar will continue to strengthen, making U.S. exports further and further uncompetitive in the global market, and you create this carry trade, and I've kind of written about this a lot, but you get into the situation where the place to be, the industry in America is financial and financial services. You make the dollar your prime export, and you turn the dollar into a funding currency where the dollar will always appreciate, especially if you look at the trade weighted dollar. That thing is just up and to the right forever. The dollar will always appreciate, but then not only that, if you're a foreigner, not only is the dollar appreciating versus your native currency, but the asset that you're investing in, whether that's Nvidia or Nasdaq or S&P or corporate bonds or U.S. real estate or pick your dollar denominated asset, that asset is also going up. So it's a positive carry trade, and we basically turned the entire economy into this kind of bizarre hyper financialized mess where the smartest people back in the day used to go work for NASA, right, to build rockets to send people to the moon. And now where do they go? They go to write a derivatives high frequency algorithm for some hedge fund. And we think that this is just kind of a natural conclusion of kind of the hyper financialization that's resulted from the dollar's reserve status and kind of just the structure of the system.
Yeah, I totally agree. And also 100 years ago, to add to your points there, you also had scientists, instead of going into finance on Wall Street and coming up with exotic derivatives that would eventually need bailouts, but in the short term, for years on end, they could make banks enormous profits until a bank blew up, and then there was counterparty risk, and then what you had contagion, and then a central bank or a government has to step in and do bailouts. Those scientists, like 100 years ago, they used to spend all their time coming up with new consumer products, or they would innovate with engines. I mean, I remember reading biographies about Ford Motor Company and Henry Ford that they said what the V8 engine was impossible. Well, it took years and tons of human ingenuity, but they eventually cracked it. So, I mean, a lot of really smart people have been wasted on financialization over the years. Talk about these markets, whether it's the eurodollar market post World War II with the Marshall Plan, and because of fiat currencies, what these bankers in Europe set up the eurodollar market basically with totally unbacked. What they created all these dollars out of thin air and just started loaning them for global trade. That's exactly what you were talking about with the dollar and financialization.
Yeah, and the Eurodollar system like the fact that we don't even know how big it really is kind of insane. You know, clearly people have tried to estimate it, and depending on what you choose to include, it's anywhere between 20 and 100 trillion. But once you start to include derivatives, it's hundreds of trillions of dollars, and like you said, it's completely unbacked. There's really no in the modern kind of monetary system, in the modern financial system, there really is no backing. That everything is just private bank credit that is printed out of thin air by a private bank most of the time. Like and the crazy thing is that I don't see a world where I getting into kind of my macro thesis, I do think that there is a world where it can kind of softly come undone. But like generally speaking, you don't unwind a Ponzi. And I think there is a way to go about it. And I think that part of what this current administration is doing is trying to unwind the eurodollar system, amongst many other things. But by addressing, Stephen Moran is the chairman of the Council of Economic Advisors, and he wrote this entire paper on basically doing just this. If you're a foreigner and you hold U.S. treasuries, you hold U.S. equities, U.S. assets, we will tax you. We might have a user fee, or we might tax the interest on the treasuries you own, something like that. Something to disincentivize foreigners from holding so many dollar-denominated assets. I think that something like that could, if implemented properly, if implemented smartly, could kind of maybe start to softly unwind it. But in general, I do kind of subscribe to the belief that you can't, gradually unwind a Ponzi, but I think that they're at least going to try to.
Well, I think the entire system post 2008, basically because of the derivatives market failures, and they lied about the size of the bailouts in the derivatives market, and with all the Wall Street investment banks, the European banks, the size of the bailouts, it was tens of trillions of dollars. I don't know the exact real number. There was a Bloomberg Freedom of Information Act request after the one-time partial Fed audit that Ron Paul and both houses of Congress got. The Bloomberg Freedom of Information request that the Levy Institute got, they got like almost 30,000 documents, and they have the estimate at 29 trillion. And then
Wow.
2019, 2020, the bailouts got even larger because the hedge funds and banks thought, oh, we're just going to get more bailouts with our bad bets. So the entire system is a Ponzi scheme. Like you said, I think 2008, it went to a Ponzi, and then these banks and hedge funds think that they're always going to get bailed out. Weren't they even talking, Robert, correct me if I'm wrong, in the last like couple months, they're even talking about, they were throwing it out there publicly about a new bailout facility for hedge funds if they do get caught on some of these trades.
Yeah. So, and this gets into what we saw today. You're referring to the basis trade bailout that's been kind of floated. I think it was by a Federal Reserve advisor, maybe even a Federal Reserve economist. And for those that are unaware, these hedge funds were levered up 20, 30, 40, 50, 60 times, shorting treasury futures and longing, the actual security. And picking up like 1, 2, 3 basis points, a very small amount. But then they were levering it up 20, 30, 40, 50 times.
And the collateral is not also, it's not also easy to tell who has the collateral, right? Because the collateral, the original U.S. Treasuries have been hypothecated and rehypothecated so many times. So that's another issue with the entire system.
Yep. And I think that this is part of what we're seeing today with this dramatic move up in yields, especially in the long end. It could be Jeffrey Gundlach was actually suggesting this kind of in a vague sort of way, and I think it does make sense that this could be part of the reason we saw a 30 basis point move in the 10-year today could be a deleveraging and unwind of some of that basis trade.
Well, there's so many over leveraged trades. I mean, you have the yen carry trade. There was a ton of bank portfolio managers and hedge fund managers that thought that they could do the yen carry trade forever, that Japan would never have immense problems, that, oh, they've gotten away with it for 30 years. It would never hit them that hard. Well, the last like 18 months, Robert, have started to prove them wrong.
Yeah, and the yen is not the only carry trade. Like the Mexican peso has also been used for a carry trade. The dollar, I would argue, is the biggest carry trade, and yet you never really hear the dollar carry trade. You always hear the yen carry trade. You never really hear the dollar carry trade, where foreigners own tens of trillions of dollars of U.S. assets on net negative, a negative 80% of GDP net international investment position. This is the real carry trade. The dollar is the real carry trade, and it's grown to such a size that, I think part of what we're seeing in the past week or so is an acknowledgement or an understanding from international investors and market participants that the era of the dollar carry trade may be coming to an end.
Now, you just talked about movement in the 10-year U.S. Treasury. The 10-year U.S. Treasury bond, I think what it was above 4.7% only 6 weeks ago. It is around 4.15% when we're recording this interview. Do you think that President Trump and U.S. Treasury Secretary, they've talked about some of this in public interviews. Scott Bessent has actually done some long podcasts recently. He was a global macro hedge fund manager. Do you think there was a plan here where they didn't care as much in the short term about the S&P 500, the stock market, if there was a 20% or more crash or correction, as long as they were able to refinance the U.S. Treasury debt at lower rates?
I do. If you listen to what they say, they're very clear that, and it's important for context. The top 10% of Americans own 92% of U.S. equities. Top 10%. And so like when they speak, they are very clear and they are very forthright that their policies are focused on Main Street. In the kind of battle between capital and labor. We know that capital has been prioritized for decades in America, and we know the results of that. This administration is making it very clear that their policies are aimed towards, shifting that balance towards a prioritization of labor. Unfortunately, I think that they are a little bit boxed in by the fiscal issues that kind of met them when they were inaugurated, and I think that that's a big driver of I think it's going to be really hard for them to get long end rates down given the state of the fiscal picture of the U.S. I think that they are much more. I think Bessent especially understands that refinancing $9 trillion worth of Treasury debt at 4% is a much different story than 4.5%, is a much different story than 3.5%. And when the debt is so large and when you're refinancing such an insane amount, every 50 bips, every 100 bips matters, and can add up to not insubstantial amount, not an unsubstantial amount of money for the taxpayer, that gets saved in interest. But since Liberation Day, when all these tariffs were announced, the 10-year is actually, last I checked at least, the 10-year is actually up. The 10-year yield is actually up from when the tariffs were announced. So we think it's going to be very hard for them to get the long end of the curve down, especially given the kind of fiscal situation they inherited.
So by fiscal situation they inherited, you mean the total size of the U.S. national debt and the budget deficits? Because basically at this point, Robert, I don't really see any good options because of the myopic short-term views. Anytime there was a financial trouble, the whichever political party was in, whether it was a new war or a Green New Deal or a quote-unquote infrastructure bill that actually wasted the funds or it was stolen, it just seems that both political parties, all they really actually agreed on was spending more.
Yeah, I mean, you look at I think it was a $9 billion EV charging bill, policy, and it built a grand total of two chargers.
Two stations, yeah, three or four stations, yeah.
Yeah, some of this stuff is just absolutely insane. I mean, it is utterly unbelievable that we were running a 7% of GDP pro-cyclical deficit. I mean, we weren't in World War III. We weren't in a horrible recession. I would argue we parts of America have been in a recession for a while. But in terms of NBER officially defined recession, we were not in one. We were not in an officially declared war. Congress hadn't authorized the use of military force. We weren't in an official war, and we were running a 7% of GDP deficit. And this is just like the situation they inherited. They inherited a situation where interest expense is over 20% of tax receipts. Like
And
a
headed to
while ago.
40. I saw it could be 40 in the next couple of years too.
Well, yeah, and 2 years ago, maybe 2.5 years ago, I forget how I came across it, but I came across I think it was a Peter Schiff interview on RT. So maybe if people are interested, you could try searching for this. And it was funny because it was talking about the debt, and in this piece they mentioned African, emerging market economies that were heavily indebted, that were going through fiscal crises, and one of the metrics they used was interest payments as a percent of tax receipts, as a percent of government revenue, and like 20% for those countries was crisis level. That was send in the blue helmets. We're in a full-blown crisis. IMF is going to be restructuring, right? Like 20% was a full-blown, you're in a debt crisis.
Yeah, but they couldn't export dollars. Yeah, they couldn't export dollars and didn't have the world reserve currency though. So I mean, look at what we've gotten away with.
Of course. We have the exorbitant privilege. I think that privilege is maybe not as exorbitant as some of the policymakers in DC would like to believe, but there certainly is and has been an exorbitant privilege.
Well, the exorbitant privilege is good for the people in the DC metro area, people on Wall Street, large corporations, special interest groups, because they benefit from all the Cantillon effect, all that cheap currency and credit. Yep. It gets funneled to them either in asset prices or unbidden government contracts or other waste, fraud, corruption, and abuse that has been doled out from either bailouts or part of the government budget deficits that have been occurring. But the average person on Main Street, like you said, has not benefited from that.
Yeah, look, if you take the average hourly wage and you divide it by GDP, or you divide it by US M2 money supply, the average American has been facing decades of declining real purchasing power in their wages. You look at who's benefited from this globalization, this hyper-financialization, this Cantillon effect, and it's the top 1%. It's multinational corporations. And financial asset holders, right? If you hold millions of if you hold millions of dollars of S&P 500, you've done great too. These are the people that have outperformed GDP. This was one of the posts I did, was kind of comparing the real economy, which I took to be personal income divided by M2 as a share of M2 money supply, and the velocity of money. And then you compare that to, okay, those are clearly underperforming GDP, right? The real economy has clearly been being hollowed out for at least 2 decades. So what has been propping up GDP, right? The next logical question is, okay, well, what has been outperforming GDP? And once you run that calculation, you see that you take S&P 500 and divide it by GDP, and that thing is up and to the right. You take government debt, right, divided by GDP, government debt to GDP, that thing is up and to the right. Corporate profits, the net worth of the top 1% as a share of GDP. All of these are what have been winning out. These are the things that have been winning out as the real economy has been hollowed out.
And I would also argue that a lot of the GDP is fake. The jobs reports data is fake. It's revised downwards. At least the last 18 to 24 months, they had record amounts of downward revisions. But a lot of those jobs were government jobs. A lot of the GDP counts government spending, government employee spending, new government employee jobs, handing out Medicare, Medicaid, Social Security, EBT cards as positive for the economy. I would argue it's not positive for the economy. It's not benefiting Main Street and the small business owner.
Yeah, it's not productive, and like when you take GDP and you divide it by M2, it paints the picture very clearly. China was admitted into the WTO in December 2001, and that marked the peak in real GDP. As I calculated, GDP over M2 as a share of M2 money supply, that was the peak in our economy. Was kind of the very early 2000s. And if you look at the further in the real economy, for the real everyday American, the real purchasing power of their wages, those also peaked literally towards the end of 2001. I mean, it's almost kind of scary how well it all lines up with China's admission into the WTO, because that was when globalization really kind of accelerated, and we saw this kind of accelerating hollowing out of the real productive economy.
But
And
now you're
instead,
also,
yeah, go
sorry,
ahead.
go ahead.
Yeah, well, it it just it is it's flabbergasting to me, because I've done so much work on this, and it is so clear to me what the issues are. I mean, here's the thing. If you take the S&P 500 and divide it by gold, right? This is a pretty common, quote unquote inflation adjusted S&P 500 that people will calculate S&P over gold. It peaked at the same exact time that real GDP, as I mentioned before, real purchasing power, wages, it all peaked in the late 90s, early 2000s, right around the time China was admitted into the WTO, and globalization really took off. So it's just kind of flabbergasting to me, because I've done so much extensive, original, research on this. Is just the past, couple weeks have been pretty frustrating, seeing the response from Main Street, right? I find it frustrating that the very things that will actually help them, the very policies and the very kind of approach that will actually benefit everyday Americans are finally being implemented after decades of bipartisan, both parties perpetrating this horrible travesty on the American people for decades. You finally get an administration that's coming in that is enacting real structural foundational change that gets to the heart of where these problems, these second and third order effects in society, where they're really coming from. You finally have an administration coming in to do that, and they're met with derision and protest and violence and vandalism, right? It just, and political polarization is another consequence from a societal level of kind of I would argue, from end stage Triffin dilemma, right? Or end stage
End of empire.
hyperfinancialization.
End of
Yeah,
empire behavior.
100%, 100%.
Whether it's British Empire, Roman Empire, a lot of the empires throughout history, Chinese dynasties, there's just enormous bureaucracy, insane corruption. The economic and political elites running the government are not trustworthy. They're considered, white collar criminals or crooks. Their only goal is to self-enrich themselves, friends and family members. They don't care about the regular people. I've seen it because I've lived here in Washington, D.C. Metro for 25 years. I've seen a lot of stuff spoken off the record with a lot of government employees and lobbyists. I mean, I've seen politicians lie to get elected. Maybe some of them did have some actual honest goals. They came here, wanting change, wanting to help the regular people. And then as soon as they get here, within 6 months or 12 months, they start getting offered deals to, as long don't rock the boat, don't make changes. You get on this committee, you'll be worth $10 million in net worth with all these deals, or inside information on stock trades, or rezoning of land laws and other types of perks. Will funnel millions of dollars to your fake charity for your family and friends in only, under 10 years. I just see it. I've seen it so many times, I've lost count.
Yeah, and we've created such an economy where, if you're in the swamp of Washington, D.C. or Manhattan or San Francisco, you've been doing great, right? Mm-hmm. But if you look at a map of America, flyover country has been just absolutely brutalized. Like the real soul, and I've traveled a lot. I've been to almost every state in the country, and there's such an elitism. There is such a condescension from coastal kind of elites, right? Well-educated coastal elites. There's such a condescending attitude towards people that are some of the nicest, most honest, most hardworking people that you'll ever meet. And I think that the political polarization we've seen, unfortunately, is just an indication of the policies that have been perpetrated by both parties. Both parties have done this. Both parties created this scenario where, I would argue Trump is not really a Republican, right? You go down number one, he was a registered Democrat for most of his life, right? Anti-war, like Democrats used to be, anti kind of big pharma with the RFK right? Make
Well, so
America
was
health.
Reagan. I mean, I would argue that the Republican Party is being schismed or reformed into more of
Yeah.
a populist based on what is polling. So he's reformed the Republican Party. Not that Mitch McConnell, Lindsey Graham, and those other clowns were actually conservatives anyway. I mean, those guys were pro-war and corrupt. They never met a war they didn't want to spend on, and they were funneling the government budget deficits into the military-industrial complex.
Yeah, I mean, this is a uniparty story, and I agree that there's kind of the possibility here that I see, at least, for the emergence of a populist kind of centrist party, right? Like, if you look at what Trump is actually doing, it's not really that radical, right? Like, and I think that especially economic populism, there is this huge potential. I mean, if you go back to 2016. I remember specifically vividly watching interviews on MSM on mainstream media where they were in the Rust Belt and they were talking to voters and they were saying, you know, who are your choices for president? And these people were saying, oh, it's between Trump and Bernie. And these people were melting down. Their brains were breaking. They could not imagine a world where someone is split between Bernie Sanders and Donald Trump. But the reality of the situation is that, again, it gets to the heart of this kind of economic populist uprising that I think most of America has been so brutalized for so long by both parties that they're not really partisan per se. They're much more populist and much more willing to unite, I think, behind an agenda that they can get behind. And I think that is largely what we saw with Trump.
I think Bernie actually won the nomination in 2016 and he was bought off. I don't want to go into any more of the details, but some of the rumors I heard were very, very disturbing. He basically just gave up, rescinded the nomination. He had, I think, won the polling and then he just backed off because, it was supposed to be her time.
Yeah, I mean, when it comes to Trump, like you look at the people he's surrounded with, RFK. I mean, he himself was a registered Democrat most of his life. Tulsi Gabbard,
Yeah,
RFK,
Elon was too,
Elon.
yeah.
Yeah, like all these people. It is
They're
so
moderate. They were moderate Democrats, a lot of them.
moderate Democrats.
I think
Yeah.
Ronald Reagan was too. I think Ronald Reagan said the party left him. He said he was a moderate Democrat and he had to switch.
Yep, exactly. And I think I do agree that there's kind of a reorientation going on politically speaking. I if I could have one wish politically, it would be that a new party emerges that is not Republican, not Democrat, that is, the real you talk to most normal everyday people, they are not on the far left, they are not on the far right. They just want a decent life. They want a job that pays well, where they can provide for their family and have a decent life. That is all most people want, and to be safe, right? They want to be safe. They don't want to have criminals pouring into their country. They don't want to have, criminals, perpetrating crimes and being let free. Like in general, most people are fairly moderate. And I think that you see this in the official numbers, right? Like you look, and independents are the largest voting base for the first time in at least a few decades, certainly in my life. Independents now outnumber both Republicans and Democrats. So I think that there's an opportunity for an emergence of a real kind of nonpartisan, populist sort of party that is not extreme and that actually does care about the everyday American.
Now, I want to talk. You talked about like a tax on dollar assets. I don't think a lot of these other governments necessarily want a gold standard because it's not flexible. Even if it was a fractional gold standard, I mean, like governments historically have cheated on it. I don't think a lot of these governments and central banks want a flexible gold standard. I've seen them talk about central bank digital currencies. Why do you think these governments then are allocating, instead of to US Treasuries, these non-G7 ones, why do you think they're allocating their trade surpluses, foreign exchange reserves into gold, some of them into Bitcoin? Is it just a hedge then against problems with the dollar?
I think so. Yeah, and I think it's already started. I often point out recently, the dollar has already been devalued, right? We talk about the debt, we talk about the real value of the debt, and Luke Groman's, done great work on this. But we talk about, the need for the real value of the debt to be devalued. Well, the dollar's already been devalued by over 60% in the past 18 months. You look at the U.S. dollar gold price, the U.S. dollar gold cross, and the thing is up like 65% in the past 18 months. So like a lot of these things have already started. I believe that the rest of the world has already kind of got the writing on the wall. I mean, you look at the as a share of the total government debt, how much is held by foreigners. That number has been declining for like not just a year or two, but like 10, 12, 15 years. For over a decade, the foreigners on a net basis have not really been buying our debt as a share of the total debt. And so like a lot of these kind of things that at least somewhat recently were kind of tinfoil conspiracy kind of things, or looked at that way. Like they've already started to play out. Like it's just objective reality. Gold is a perfect. If you are a country running a trade surplus, after what we did in 2022 to Russia's foreign exchange reserves, would you want to hold US treasuries? Even if
Absolutely
you're,
not.
even if you're an ally, right? Like, because, okay, we might be an ally today, but are we an ally tomorrow? Gold is, you don't have that issue with gold. You don't have that issue with Bitcoin. And I do believe that Bitcoin will start to see more of those flows, more of those kind of structural trade surplus flows. I think, even if it's only 5 or 10% at first, Bitcoin is such a small market that will be meaningful. And I think it steadily grows from there. But yeah, gold and Bitcoin both serve the properties of them are everything that the U.S. Treasury and the U.S. dollar denominated asset is not.
And you're also starting to see a lot of other countries have banking system problems, recession, budget deficit problems, currency problems. Case in point, Japan, one of those examples, whether it's with their banking system or their currency, when they want to defend their currency, their exchange rate, they have to sell treasuries. So the normal buyers of US treasuries, the large ones, the last couple decades that were Japan and China that would recycle all their foreign exchange reserves, the US wouldn't even have to worry about it. They'd be buying the treasuries up hand over fist. Those days are over. And yet now here we have just base case, we have budget deficits way over $1 trillion. When Biden left, I had the budget deficit is closer to 3 trillion. Interest payments on the national debt, they're what 1.2, 1.3 trillion annualized.
Yep.
Before, Robert, I forgot to mention this point. We had for almost 15 years, I think the interest payments on the national debt, even though the debt was exploding higher, it was like a teaser rate on a credit card. I think it was only like 3 or 400 billion a year in interest payments. That was almost nothing.
Yeah, that's correct. Yeah, the price insensitive buyers, the persistent sovereign buyers of U.S. debt, are starting to disappear, and we have some auctions, treasury auctions this week. Like I mentioned before, I think this move in yields today is starting to paint a picture. The auctions, will put further color on that picture. But yeah, I think the old regime where these foreign countries that ran surpluses against us were just these price insensitive, persistent sovereign bids under U.S. treasuries. I think those days are over. You look at who are the biggest marginal buyers, and it's all tax havens, Cayman Islands and Ireland and Luxembourg. So it's hedge funds that are trading, right, fast money, that are trading U.S. treasuries. They're probably involved in the basis trade that we were talking about before, right? Like that is who is our biggest sovereign bidder, is hedge funds in these tax haven countries, or maybe stablecoin issuers. The real big players that used to buy our debt, no matter what, they would always recycle those surpluses into treasuries. Those days are over. Luke Gromen has said that on a net basis, China stopped buying U.S. treasuries in 2014, which is clearly over 10 years ago.
So as we wrap up here, Robert, and I really enjoyed this discussion here. We'll have to have you back on again in the near future. For people on Main Street, retail investors, how do you think they should protect themselves? Because it sounds like there's going to be a lot more volatility. We're seeing that in the bond market. We're seeing that in the VIX, in the stock market. Do they need cash? Do they need gold? Because it looks like there's going to be a lot of inflation and currency debasement. If you hold a lot of cash, I mean, you especially over the long term for years, you can end up losing as the government intentionally tries to debase the currency.
Yeah, I mean, it all depends on time horizon. I would say that like equities are poor. I'm not very constructive on U.S. equities moving forward. Now, of course, there'll be idiosyncratic stories, maybe U.S. domestic manufacturers, something like that. But generally speaking, U.S. equities are poor. Gold and Bitcoin, I think that it was looking a little hard to bid gold, right? Given its like parabolic rise, it's since pulled back in the past couple of days, and it looks like a much more attractive entry. I think gold, long term, as long as your time horizon is over a year or two, I think gold and Bitcoin are both really good choices. I think cash is also a decent choice, getting 4.3% in a money market fund. I think that at least until some clarity develops, that is probably, a mix of those is probably the best move. But you have China talking about a 15 to 30% devaluation of their currency. I think, trade wars lead to currency wars, and we're clearly in a trade war. The next step is a currency war. Things could get pretty ugly, especially with the fiscal position the U.S. finds itself in. So, yeah, I think gold, Bitcoin are a great hedge to the kind of, nothing stops this train, big print, right, sort of problem. And I think cash in a money market fund is also reasonably defensive.
And you also have countries, not only do you have retaliatory tariffs and a trade war and potentially currency games with that to try to devalue their currency in a number of different countries, emerging markets or China, to do that to try to boost inflation, to fight deflation. I'm using air quotes here. I'm not a fan of Keynesian economics and dollar pegs and those types of neo-mercantilism. But I also think, unfortunately, what financial history says, and we're getting into kind of bad policies repeating themselves, whether it's the Smoot-Hawley Tariff Act, post-October 1929 crash from the Herbert Hoover administration in Congress, and an FDR doubling down. We could also see export bans on certain types of commodities and natural resources. So I could see the U.S., making investment a priority into a lot of mines as long as there's a Republican-controlled Congress. He's already put up tariffs on imported aluminum and steel and I think copper. So I could see that would be counterintuitive, because if we do have a global economy problem, recession, depression, normally those types of industrial metals would not do well, but we could see a rise in those too.
Yeah, no, that's 100% true. And I would point out, the U.S. is blessed. We have everything we need. I grew up in Southern California. The Salton Sea is a wasteland, right? There is nothing in the Salton Sea really that matters. And it has extensive lithium deposits. So I think that some of the largest in the world. The U.S. is very blessed, and I think it's a good point. I think we do have. We could use if we chose to, we could shift, kind of reorient our mindset towards, taking advantage of the resources that we're so blessed with.
Yeah, U.S. has tons of copper and a lot of gold mining deposits in Nevada and Arizona, a lot of others. It's just a nightmare for a lot of these areas to get permitting process through in some of these cases. It could take way over a decade, sometimes 2 or 3 decades, to get all the permitting through at the state, local, and federal levels.
Yeah. Yeah, no, I agree. I think it's a really volatile situation that we find ourselves in. I think it's a really uncertain situation that we find ourselves in. And I think that just kind of staying alive and staying solvent, not being too levered, and just kind of surviving, I think that's probably the prime goal for the next couple years.
Yeah, until we see someone panic, maybe the Federal Reserve Bank panics and cuts rates and does a 180, maybe they have to go into the bond market and start monetizing debt, because if those rates get too high and the US Treasury can't refinance at the rates it wants, I could see a Federal Reserve Bank panic if the stock market did crash at some point.
Yeah, this move up in long-term rates today has got to be starting to concern some people. I just can't see how it's not. And I think that the end goal has got to be some form of debt monetization, some form of negative real rates, some form of financial repression. I don't think we're growing our way out of this, especially not with the current approach of kind of a more mercantilist approach. We don't have the domestic manufacturing. It's going to take years and trillions of dollars. It's not ready to go here in the domestic economy. So the kind of grow our way out of it, I don't see that as an option anymore. If we're going to take a much more nationalist, protectionist approach, I don't see that grow our way out. It's no big deal. as being viable anymore. And so that leaves you with, okay, either a nominal default. I don't think that will ever happen, or a default in real terms, meaning, negative real interest rates, financial repression, similar to after World War II, where the last time debt to GDP was this high, what we did was we ran negative real rates along with the rest of the world, and we basically inflated the debt away.
And that's called yield curve control or financial repression. I think the new phrase that they're using is fiscal dominance, but it's
Yep.
really just financial repression or yield curve control. Like Robert said, it was used post World War II to quote unquote inflate a lot of the debt away. So the real inflation rate back then was much higher than the consumer price index in the 1940s, 50s, and 60s. Then you got to stagflation era by the late 60s and 70s. So the people started to realize that inflation was way worse. And then you had Paul Volcker come in and raise interest rates enormously to try to fight inflation. Well, at that point, we can't really raise interest rates anymore because the U.S. federal government can't afford the interest payments on the debt if the central bank started to raise interest rates. Although I think at this point, Robert, I think Trump, like, he's made his position clear because he posts on social media and does all these TV interviews. He wants rates cut, but you have Jerome Powell fighting him on that for now.
Yeah, and I think it'll be a huge kind of battle to watch. I said this was one of the four main things I was watching for 2025. In kind of my year ahead article, I said the battle between the incoming administration and the Federal Reserve, especially Jerome Powell, they'll be one of the key things to watch, and I think it's just starting to heat up.
And because of the volatility in asset prices and stocks and bonds right now, the uncertainty with all these policies, retaliatory tariffs, negotiating the trade deals. I mean, I think Trump was expecting the Trump tax cuts to get passed first before the tariffs went into effect, and that didn't happen. So now things are out of order and even more of a mess. I think we could see. I'm not saying short term prediction. I'm saying like maybe 18, 24 months from now, we could see gold at 3,500, maybe even $4,000 an ounce. So in the short term, maybe there's a correction, nice trading range. It takes out like all the short term traders that thought it was going to go straight up. That's good long term for the market. I think we could see another big move in gold in the next couple of years.
100%. Yeah. And I would say that like the order of operations for a lot of these things matters when sovereign debt to GDP is 125%, when private debt to GDP is 155%. Uh, for example, if we go into a recession, if the recessionistas finally get their wish and we go into a recession here, on average from my work, the deficit as a share of GDP increases by 600 to 800 basis points. So 6 to 8%. We're already at 7% of GDP running this pro-cyclical, utterly insane deficit. That takes us to 15%. And of course, these things are non-linear and they're also vicious cycles. So, like, very quickly, a recession could get us into a very, very bad situation where the only way I've always described a recession as a margin call on the debt. And I think it's a useful analogy, but any sort of growth issues where tax receipts fall, even if you're cutting spending, right, with Doge, like they're not cutting nearly enough to make a dent, right? If tax receipts fall because of how hyper financialized we are utterly dependent on asset prices going up forever, capital gains, right? So when asset prices start to fall, capital gains start to fall, U.S. government revenue, tax receipts start to fall because they're so intertwined, right? And
And you
you're
still have these interest payments on the debt that are $1 trillion or more. So they haven't made a dent in that. The national debt is still growing. So you still have these budget deficits and trade deficits. So we're just basically at kind of, I would say, an accelerated timeline for the end stages of Triffin's dilemma. It took years longer than many people thought. Because the gold community was saying for many, many years that this would happen a long time ago. But here we are now. Now finally, we've got to the point where all the math just doesn't work up. Whether the interest payments on the debt, the budget deficits, the trade, it's just too much.
Yep. I totally agree.
Well, I want to thank you so much for your time today, Robert. I feel like I could go on and on about you with the macro. You really know your stuff. Congratulations. You're doing good work over at your new company.
Thank you. Appreciate it. It was a great conversation.
And how do my listeners follow you on X?
On X, I'm at Infra, INFRAA _. And I just started YouTube called Infranomics on YouTube.